back on Morning Movers. Dell will be in the spotlight this afternoon when the company reports second quarter earnings. Analysts are expecting earnings per share of $2.31 on an adjusted basis. Revenue is expected to come in at nearly $30 billion. Dell is up 100% since hitting its tariff-induced low on April 7th. Time now for Options Corner. Joining us to take a deeper look at Dell is Rick Ducat, lead market technician here on Schwab Network. All right, Dell's been an outperformer compared to the S&P 500. Slight outperformer. What trends do you notice, Rick?
Yes, as you said, Diane, a very strong rally off of those lows, but actually underperforming the tech sector after this spike to the upside, now kind of sitting in between the broader index and its own tech sector here. To consider Dell against some other more similar companies here, Dell kind of does a few different things. One is storage, one is personal computers, one is more like data infrastructure. So storage is doing really strong. Western Digital and Seagate are the outperformers here. IBM, kind of more the infrastructure company, pretty much in line with Dell. HPQ, personal computers, not doing quite so well during the past year, down about 22%. So an interesting kind of picture to break down the sector a little bit more to think about here. But if we were to look at Dell's chart more specifically here, we can see our yearly chart shows that Dell was progressing to the upside in this channel type shape between our two blue dashed lines there, but that gave up its momentum right about here near 140, our pink line. If you were to backtrack here, you can see that was a notable high point before we had that brief spike to the upside that then translated to the broader downward move. Notice our red and green lines as well also mark significant points that have come back into focus, 135 and 128 for some support and resistance to think about here. One other thing you might consider here, a head and shoulders type pattern could potentially be forming here. Shoulder, head, and then traders might be looking for a shoulder to form right around that 135 level that I just mentioned, with the neckline or the ultimate supportive area being at our green line around 128 here. So if we were to look at our other studies here, we can see that, we can see that our expected move coming in would be about 7.8% for the end of the week here for this earnings move to digest here. So a rather wide potential range in a rather short amount of time.
All right. Thank you, Rick. Appreciate it. Now to take us through an example trade, we've got Tom White, senior options contributor and co-host of Fast Market. All right, Tom. So how would you go about an example trade for Dell, given we've got earnings right in front of us?
Yeah, really short-term positioning here that I'm looking at due to the fact that we got earnings on a Thursday, expiration on the August 29th weekly cycle. It's tomorrow at the close. Seen some muted moves recently, and most notably NVIDIA post-earnings, right? Rick mentioned the segments that they're involved in, but the data center build-out, that AI infrastructure build-out, is the key for them. That's where they're most profitable on this one. So I looked at a strategy that takes advantage of the short time frame and the higher implied volatility. So I looked at a short iron condor. We sometimes refer to this as a short iron butterfly because I'm selling the call and put on the same strike. So let's break this one down for you. August 29th weekly options, 1 day to expiration. We're going to sell the 132 strike call and the 132 strike put. So we're selling a straddle there right at the money at the 132 strike. And then to make it risk defined, because anything can happen post earnings, we're going to buy the 121 strike put on the downside out of the money, and then we're going to buy the 143 strike call. So this short iron butterfly where we're buying the wings and selling the body of this strategy, we're going to be able to collect about a $7.80 credit on this position here. And what does that mean? Well, that's how much I can make, $780 on an $11 wide short iron butterfly here. It takes my break evens to the downside, about 124.20, and then all the way up at 139.80 to the upside before I start getting hurt on this one. So $11 wide minus the $7.80 that I collect on this one means that you've got about a just over a $2 potential risk on this, but that's all the way below the 121 strike or all the way above the 143 strike. So in this type of instance, what you want is a neutral move, a consolidation in the shares post earnings. Now, if you think the stock's going to move maybe that 1 or 2 standard deviations to the upside or the downside. You don't do a strategy like this. What you're trying to do on this, Diana, is trying to take advantage of that higher implied volatility. And because we only have 1 day to expiration on this one, we're going to see that vol crush post earnings. And then also, because you're just 1 day or about 24 hours from expiration, that's also going to decrease the price. And the object here is that you sell it at $7.80, you buy it back a lot cheaper, but the whole theory behind this is it's not bullish, it's not bearish, it's neutral. You want it to stay between those break even, see that vol crush lower the price, then you can buy it back at a cheaper level.
All right. Thank you, Tom. That's an iron condor example trade approach there for Dell. That stock has earnings coming after the closing bell today.